Don't risk the chance of getting in trouble when paying yourself as a single member LLC. There are important steps that you need to take before you take any money out of your business bank account. Hi and welcome back. If you're new here, my name is Paige. I'm the owner and lead attorney behind The Legal Page. I help small businesses get legally legit in no time without breaking into hives. If simple and easy legal tips are just what you need, please subscribe to my channel. So step number one before we get into anything is you actually need to get a business bank account with your employer identification number. If you don't know what an EIN is or if you should actually be getting one, please watch my video here on how to legally start a business, and I give you all of that information. If you know what an EIN is and you just need to be issued one, then all you need to do is go to the irs.gov website and click on apply for my federal EIN number. You're going to go through the application process. It takes anywhere from about 5 to 10 minutes. And then the good news is you will be issued that number automatically, so there is no wait time. Once you have your employer identification number, and whether you're a sole proprietor, you're going to use your social security number, or if you're an LLC, you're going to use your LLC registration number. Those numbers with your EIN number, or either of those numbers with your EIN number, is going to allow you to open a business bank account with the bank of your choosing. When you choose your bank, it's always good to look for business bank account opening incentives, because taking advantage of those could actually give you some additional income in your business bank account when you first open it. Step number two, once you actually have the business bank account, is you need to determine how you're actually going to pay yourself as the owner of a limited liability company. So single member LLCs pay themselves in two very specific ways, and you just need to choose one. One, through an owner's draw, and two, through a salary or an actual amount you're making as an employee through your business. Single-owned LLC members have the option to take out what's called an owner's draw. This is where you write a check to yourself or you transfer money from your business bank account to your personal account to pay yourself for the work that you've done as the owner of this business. And this money is going to be taxed the exact same because an LLC is a pass-through taxation entity. So it's going to be taxed the same whether it's the profits to the business or your profits as the owner's pay. This is how most, like 99% of single member LLCs that are, solopreneurs, online small business owners are going to pay themselves because it's the simplest way. All you have to do is make that bank transfer to your personal account. Remember here that you can make that owner transfer at any time. So say on a random Tuesday, you need $800 and you want to pay yourself from your business bank account, you can do that. And then if you want to pay yourself 5 days later, you can do that. And then a month later, you can do that. Or if you want to keep it more consistent, which is what I suggest just for, banking purposes and bookkeeping purposes at the end of the year, it's good to make that transfer, say bi-weekly or monthly, and keep it the same rate or within kind of the same rate range. Now, if you want to pay yourself as a salaried employee, I actually suggest that you probably want to become an S corporation, and I'm not going to explain the logistics of becoming an S corporation in this video because it would be very long and drawn out. So I've linked some good resources below if you're interested in becoming an S corporation and putting yourself on payroll. The benefit to this overall is that you do receive some tax liability benefits at the end of the year, and you probably won't have to pay as much in taxes at the end of the year as an S corporation. So back to putting yourself on payroll, you're going to need to fill out a W-2 and an I-9, just like any other employee would. You're going to have to use a payroll service. You can be your own payroll service, or you can use your CPA as a payroll service. And then you're going to be issuing yourself very consistent pay stubs or dates that you're paying yourself, whether that's bi-weekly or monthly. And then you do have to have your state and federal taxes taken out of that paycheck on that consistent basis that you've chosen. And then if you have state income taxes as well, some states do, some states don't, you will have that taken out of your paycheck every pay period as well. So you have some options on how you want to pay yourself. One, you can pay yourself through an owner distribution from time to time. Just ensure that that transaction is noted from your business bank account into your personal checking account. And two, you can put yourself on payroll, although I don't really recommend this unless you are an LLC that is actually designated as an S corporation for tax purposes. If you're on salary as an LLC and you have employees, it's always a good idea to get set up, like I said, with a payroll service. You can use Gusto or QuickBook Payroll if you you want to do it on your own. I have found as a small business owner, it's a lot easier to delegate and outsource that task to an actual CPA who runs payroll services. Also, they have professional liability insurance, which is good, so that you know everything is getting done by a professional. And then you as the business owner would just receive a pay stub on your pay period dates when you are wanting to pay yourself that salaried amount. I'd love to chat with you in the comments, so please be sure to let me know whether you are going to pay yourself through an owner distribution or on salary as an employee for your business in the comments below. Step number 3 is to determine how much and when to pay yourself. So first things first here, do you have an operating agreement as an LLC? If you didn't have an operating agreement, then just, bypass what I'm going to say here. But if you do have an operating agreement, oftentimes those operating agreements explain when people need to get paid through the LLC, whether that's monthly or if you're a salaried employee, weekly, bi-weekly, monthly, so on and so forth. However, if you started a business and you do have an operating agreement, sometimes those operating agreements don't have within them, in the legal language in them, when you're going to need to pay yourself. So that's up to you as the owner of the Single Member LLC. You have the management authority to decide, which is good. Here, I always suggest that you look at your financials, possibly and hopefully over the past 3 to 6 months if you have those financials to look at. If you don't have those financials to look at and you're just starting as a business owner in the industry, I would suggest that you wait to pay yourself a consistent amount and you just pay yourself every so often until you can actually look back at your financials. So if you do have the financials for 3 to 6 months, then say you're making around $10,000 a month on average in your gross sales. So with those gross sales for service-based businesses, usually your payroll expenses are a bit higher, around 50%. So I always tell people to do 50% or less for their owner distribution pay if that's the way that you're going to go about this. So I would say if you're making around $10K in gross sales on average for 3 to 6 months, then you are pretty well set to pay yourself around $5K, 50% or less as owner distribution every single month. And again, this owner distribution can be flexible, so you don't have to do 5K. You could do 3K sometimes, you could do 6K sometimes, but you just want to ensure that you're probably staying under that 50% of payroll costs from your gross sales. Another option is to just determine a reasonable salary for yourself, as long as you can hit that reasonable salary with, of course, your business income coming in. Now, to determine a reasonable salary, sometimes people just come up with it randomly, but I suggest that you actually do some research and figure out what a similar business owner would make if they were like a W-2 employee working for a company within your region. A good option to research this is Indeed.com. Kind of put in what you do if you're a freelancer, or if, say you're an operations manager for different businesses, then you just want to put in operations manager within a business within your vicinity, and that's a good reasonable salary as a starting base to start out with to know what to pay yourself on a month-to-month basis. A reminder here is that if you are taking an owner's draw, which is what the majority of you listening here are going to be doing, you also need to be saving for taxes. I'm going to talk more about that in the next step, but you also need to save for business expenses that could come up in your business. You want to have some type of emergency fund for your business as well, and then you want to save for taxes. So a good book to read if you want to know kind of how to allocate all of these different savings accounts as a business owner is Profit First. I'll link that in the description below as well. Step number 4 is how much do you need to set aside for taxes? I always tell business owners to start out around 25%, and I'm going to break that down for you here. But the reason being is you want to probably overcompensate for the taxes that you're going to pay rather than undercompensate, and then you're going to have to find the money at the end of the year when you're paying your tax return. Remember, as a single member LLC, it's a pass-through taxation entity, so all you have to do is file a Schedule C with your personal tax return for your business profits through your LLC, and then that is going to pass through to your personal tax return, and at that point is when you're going to pay your business taxes. So the good news here is that as an LLC, you're not going to be double taxed. C Corps are double taxed, but LLCs aren't. So you're not going to have to pay income taxes through your business profits taxes and pay your personal taxes through the owner distributions that you paid yourself. It's just a one-time tax thing at the end of the year through your Schedule C. But this step is really important for people who pay themselves owner distributions because you're not getting yourself on payroll. You're not paying taxes throughout the entire year. You're just probably paying taxes either quarterly if you do plan on paying more than about $1,000 worth of taxes. The IRS does mandate that you pay quarterly taxes. For new business owners, it may take a couple of years to realize whether or not you are obligated to pay quarterly taxes. For all intensive purposes, we're just going to talk here about giving yourself an owner distribution here and there throughout the year to pay yourself, and that ultimately you haven't paid any quarterly taxes, and so now you're left in tax season from the previous year, looking at your owner distributions and looking at your business income and how much you're actually going to have to pay in taxes. And that's going to be the same because all of that is going to be reported on your Schedule C. Okay, I want to give an example here so it's a little bit more clear. Say your business profited, like a net profit of around $50,000 for the year, but owner distributions that you paid yourself was around $30,000 in total. So you have $30,000 of owner distributions and $20,000 worth of profit. You're not going to be double taxed on that $20,000 because it's business profit and it's passing through to your personal tax return. You're only going to be taxed on the entire $50,000 once on your personal tax return because obviously the owner's distributions are going to be on your personal tax return, but that additional $20,000 just looks like personal profit and income to the IRS as a single member LLC. And so you're going to be taxed the same for the $50,000 as an LLC just through your Schedule C on your personal tax return. Okay, so let's break down what taxes you're actually going to have to pay. The first is self-employment taxes, and this is really important for LLCs. Because you're not a W-2 employee, you're not getting these self-employment taxes taken out just like you would paying these taxes as a W-2 employee. So the federal government makes you pay them as a self-employed individual. The self-employment taxes amount to about 15%, give or take. That could change depending on when you watch this video. And it's Social Security taxes and Medicaid taxes. This rate consists of two different parts. First is your Social Security taxes, around 12%, give or take. Like I said, there's usually tenth percentages there, but 12% in Social Security taxes is going to cover old age, disability insurance, those type of things. And then you're going to have about 3% for Medicare, which is medical insurance, and those taxes are going to be what you have to pay at the end of the year as well. So you're going to need to calculate what do you anticipate your entire net profit to be for your business, and then also add in your owner distributions and take about 15% for self-employment taxes of that into a separate tax account. I always suggest you just have a tax savings account. That way you're not fishing for funds or worried about the depletion of your business bank account come tax season. You've already saved appropriately every single month. So I always just say when you do take an owner's distribution, take 15% more of that from your business bank account and put it into your tax savings account. An additional tax rate that you will have to pay is your federal income taxes. Now, this tax rate is going to depend on your federal tax bracket, and I can't tell you what that is. I've linked the tax brackets below for the time being with the IRS, but it's going to be anywhere from about 10% to 37%. If you're a new business owner, you're probably in the 10 to 12 to 20% tax bracket. So you don't need to worry too much about saving 37, almost 40% of your business income for tax purposes. If you don't plan on making over six figures the first year or two in business, which is probably the majority of business owners, you don't have to worry too much about saving an overabundance of money for federal income tax purposes. But like I said, I always say about 25% total is what you want to start at for saving for your tax liability at the end of the year. You're going to have about 15% coming in for your self-employment taxes, and that's going to be the amount that you have to pay with your Schedule C through your personal tax return, and you're going to be paying probably anywhere for 10 to 12% for federal income taxes. So we're getting close to that 25%. We might be slightly above it here, but a lot of it washes out with business expenses as well. And then I also wanted to just note state income taxes are something you want to keep in mind. Some states have state income taxes, some don't, but you'll have to pay those at the end of the year as well. If you're not a W-2 employee on payroll, then you have to pay those as well through your Schedule C at the end of the year. Hence, all in all, I said about 25%. I think 25% is a good starting point. Anywhere from about 25% to 30% is going to set you in a really good position come tax season. So again, you're not having to take an absorbent amount of money out of your business banking account. You already have that readily available and saved in a tax savings account. Step number 5 is to determine how much you need to set aside for business expenses. You're not going to know this number, and I can't tell you what number you need to set aside for business expenses until you actually start operating your business. But like I said, it's good to keep your payroll expenses, so your owner's distributions if you're a single member LLC, at or under 50%. You're going to take all of that into account for your tax liability at the end of the year. I always suggest around 25% of what your net profits are going to be for your business, including owner's distribution. That will be within a tax savings account. And then all of the rest is probably going to be business expenses. So these percentages are flexible, like I said, but business expenses you also probably want to keep under around 10%. And here's the reason why. You want to have some type of business profit as well. So you don't want to expend the rest of your money on your business through various expenses just because you can, and you don't want those to be taxed. It's actually better to keep a profit in your business, even if those are going to be taxed, because then your business looks better on paper as a for-profit business. And for accounting purposes, you're actually going to have a business basis that is in the positive instead of a zero. So a good rule of thumb for business expenses is 10% or under. If you go above that, I definitely want you to look at your business expenses and see if you can cut anything, especially if you're just within the few first years of being a business owner. As time goes on, you are probably going to have to accrue more assets and more business expense liability. So you could bump up anywhere from 15 to 20%. But I always just suggest keep your overhead costs really low as business expenses when you are just starting out. If you're finding this information helpful, be sure to give this video a thumbs up. Alrighty, let's get into the last step of legally paying yourself. Step number 6 is to record how much you're paying yourself. So if you're taking an owner's distribution, you just want to make sure that that transaction is noted within your business bank account. Usually you would also note this in a system such as QuickBooks or through your bookkeeper if you do monthly bookkeeping. If you don't do monthly bookkeeping and you're just a solo entrepreneur wearing all of the hats, then just make sure that that transaction is noted and that cha-ching moment is going from your business bank account to your personal account so that you can go back and look at your finances at the end of the year for tax purposes and see how much you actually took as an owner distribution. On the other hand, if you're paying yourself a salary on a consistent pay basis, then you're going to be issued a pay stub. And all of those pay stubs are going to be combined together into a W-2 that your business will issue to you personally at the end of the year for your tax filing purposes. All in all, when it comes to when and how to pay yourself as a business owner, there are several factors to keep in mind that I've talked about here. You need to make sure that you're saving for taxes, you're taking into account business expenses, you're taking into account business profit, and that you're not having too high of payroll expenses with your business. You can also pay yourself through an owner's distribution or as a salaried employee. It is a constant balance as a business owner when looking at how much is coming into your business versus how much is going out. As a new business owner, I do always suggest that you just maybe don't pay yourself as much from the get-go and you take a period of time to see how much income is actually coming into your business before taking any of those big owner distributions. And it's not only extremely important that you pay yourself legally as a business owner, but that you also set up your business legally from the beginning. If you look at this video that just popped up on your screen here, I have created another video just for you on 7 easy steps to get your business set up and protected from the get-go. So click on that video right now and I'll see you over there.